Thanks for sitting down with me today, Dave, to provide what's sure to be a packed economic update.
Happy to be here with you, Joe.
So, Dave, it appears that the market is saying that the Fed's aggressive response to what seems like persistently high inflation will inevitably lead to recession. Is it true that recession is right around the corner?
Yeah, well, Joe, it depends on one's definition of recession. A commonly held belief is that recession occurs when the economy is contracted for 2 consecutive quarters. And for the first quarter this year, the Labor Department's Bureau of Economic Analysis reported that negative real economic growth of 1.5%.
So let me stop there real quick, Dave. What do you mean by real economic growth?
So I'm glad you asked, Joe, because whenever we talk about GDP or gross domestic product, we're always talking about how the economy is doing on an inflation-adjusted basis. Growth occurs when the economy produces more goods and services. So when we say that GDP growth was 2%, we're saying that the economy produced 2% more goods and services than it did in the prior period, irrespective of any price increases charged for those goods and services. So now, as you can see on the left-hand side of the slide, as of July 8th, the Atlanta Federal Reserve is forecasting that the economy contracted in the second quarter by 1.2%, meaning that we produced less stuff and provided fewer services than we did in the prior quarter. Hence, if the Atlanta Fed is correct, and if we believe the commonly understood definition, then we're already in a recession. The right hand of the chart shows the evolution of full-year GDP growth based on the forecasts of over 70 business and financial economists that are surveyed by the Wall Street Journal. And over the span of just a few short months, they've lowered their collective 2022 GDP growth forecast from about 3.6% to just under 1.3%. And I'll have more to say about forecasting a little later. Now, however, according to the Bureau of Economic Analysis, 2 consecutive quarters of negative GDP growth is not an official definition. In the U.S., we rely on the independent, private, nonprofit National Bureau of Economic Research to declare when the U.S. is in a recession. They consider numerous factors in reaching such a decision, including employment conditions, personal income, and industrial production. So the BEA states that while negative GDP growth and recessions closely track each other, the consideration by the NBER of the monthly indicators, especially employment, means that 2 consecutive quarters of negative GDP growth does not always hold.
So then, since we continue to see positive employment data, we shouldn't even be talking about a recession even if the economy contracted in the second quarter, correct?
Yeah, that's right, Joe. Let's look at some employment data. The first chart looks at the number of Americans employed since 2000. During the last 22 years, we've had 3 recessions, as indicated by the 3 shaded areas in this chart. The first occurred after the tech bubble burst at the turn of the century. The second after the housing bubble burst in 2008, a period that we now refer to as the Great Recession. The third was the steep economic downturn caused by the pandemic that we recently experienced. In each of these cases, America lost jobs. And in the case of the pandemic, the job losses were massive. But as you can see, Joe, the number of Americans employed continues to move higher, with 372,000 jobs added in June, which is about the same number of jobs that were added in April and May. Now, while this slide looks at the total number of people employed, let's take a look at 2 other measures of the health of the jobs market. The chart on the left shows the unemployment rate, which has held steady at 3.6% for the last 4 months. What's important to note, Joe, is that there have only been 4 months in the last 50 years when the unemployment rate has been lower than 3.6%. Just 4 months in 50 years. A second measure of the health of the jobs market is the number of people that have lost their jobs and filed a claim for unemployment insurance. The chart on the right looks at total initial unemployment claims for the last week of June for the past 10 years. Unemployment claims tend to be cyclical, so I wanted to do a true apples-to-apples comparison, which is why I chose the June data. Also, I intentionally excluded June 2020 because there were so many people out of work then that the number would be way off the chart. The June number equals claims filed in 2018, which was the lowest number on the chart. To find a lower end of June number, you'd have to go all the way back to 1969, and that was when the workforce was much smaller than it is today. Now, certainly, all that can change over the next few months, and candidly, we've heard a number of stories over the last several weeks of companies laying off people. So the jury is still out on the unemployment picture. But as you can see on the next chart, Joe, we still have boatloads of jobs that are available. While not at levels a couple of months back, there remains over 11 million jobs that haven't been filled. Notice the headline on the right of this slide. The story reports that most layoffs are contained to crypto and real estate, and that recruiters are aggressively pursuing candidates by checking websites that announce companies laying people off. Hence, if employment is strong, which is certainly the case today, I think it's premature to declare that we're in a recession. Now, I will add that the Federal Reserve has been very aggressive in raising interest rates, and so that could have a negative impact on employment. But we'll wait and see what impact that does have.
Okay, so I get that the employment picture is great, but what I don't understand is why we're seeing this negative economic growth in a period of strong employment. I imagine we have many viewers that are confused as why the economy appears to have stalled.
Yeah, Joe, in fact, I was confused about that as well. So at the risk of getting a bit wonky on our viewers, let me try and explain. I'll start out with a chart that looks at the components of GDP and what contributes to economic growth. On the left, you can see the consumer spending, which the government refers to as personal consumption expenditures, makes up over 2/3 of our economy. Government accounts for about 1/6, and business investment accounts for about 1/8. There are a couple of other minor factors that are included as well. Now, while these segments of the economy can contribute to growth at various rates over short periods, there are only two factors that contribute to growth over the long term. That's the growth in the workforce, that is, more people making more stuff or providing more services, and productivity, when workers use better machines and more efficient processes to make more stuff with the same effort. We know that the workforce is growing much slower than it has historically. So absent any major shifts in productivity, we really can't count on economic growth being better than 2% going forward. Now, remember what I said a minute ago about consumer spending making up 2/3 of the economy. Here, we see a chart that shows the pace of consumer spending. While there was a big drop-off during the pandemic, we saw a sharp rebound that appears a meaningfully above trend. However, the numbers you see on the slide are not inflation adjusted. And remember what I said at the beginning of our discussion, Joe, we adjust for inflation when determining economic growth. So now let's look what consumer spending looks like when we adjust for inflation. The chart on the right shows that presently, consumer spending adjusted for inflation is slightly below trend. Americans are definitely spending more, but we aren't buying as much because of the erosion of purchasing power caused by inflation.
That makes sense, Dave. So the economy is shrinking because of inflation. We've heard a lot about the reasons for why we've had inflation. A major change in what consumers are buying, China's zero COVID policy, supply chain problems, and Russia's war in Ukraine. Are there any other reasons why we're seeing inflation at nearly 9% today?
Yeah, well, in fact, Joe, inflation came out yesterday at over 9%. And you bet, while all the factors you mentioned certainly played a role, there's one you didn't mention that I think is the biggest factor of all. And I'll explain in a series of 3 charts on this next slide. So remember, consumer spending is the major driver of economic growth. And what drives growth in consumer spending? growth in income. On this first chart, we're looking at the 37-year period up until 1995, when total real or inflation-adjusted personal income grew at a compounded annual rate of about 3.6%. It's important that I define personal income. Not only is it comprised of wages earned by workers, but personal income also includes Social Security payments, unemployment insurance, and any other type of government assistance to individuals. Notice this brief period in the early 80s when the growth in real wages was below trend. So why do you think that was, Joe?
My guess is that's the last time we had a period of very high inflation.
Exactly. But the growth in wages soon recovered, and we were back on trend. Now let's look at the 18 years from 1996 to 2013. By this time, the growth in the workforce was slowing compared to the prior period. So growth in incomes during the period was a full percentage point lower. We had two periods where incomes grew above trend. The first was concurrent with the tech wave, and the second was concurrent with a housing bubble. But then the great financial crisis hit, and with it a sluggish economy in which income growth remained below trend for several years, absent some government stimulus, which were represented by these two spikes that you see. So now let's take a look at the past 9 years, and this is where it really gets interesting. Look at those huge spikes in 2020 and 2021. Of course, we know that those spikes were a result of the massive government stimulus resulting from the pandemic. The government paid out way more than needed to keep personal income on trend, way more. And it's no wonder that we've seen inflation for everything from cars to food to housing to Bitcoin to meme stocks to even regular stocks. The federal government gave Americans boatloads of cash, and we spent and invested it, driving up prices across the board. And this, I believe, is the main reason why we have the inflation that we do today. We will eventually return to equilibrium, but that may take a few months or perhaps a few years. Now, there's one more chart, Joe, that I would like to present related to the U.S. economy, and that's the state of the housing market. The chart on the left shows the progression of housing prices over the last 17 years in relationship to wage growth. The average wage for rank and file employees is currently about $27.50 an hour. And while wages have a little more than doubled over this period, the price of the average home is 3.5 times what it was in 1996. The table on the right displays the dramatic increases we've seen in select cities just over the past year. And it seems to me that the lack of affordable housing could be another factor that might also interfere with the return to economic normalcy.
So Dave, we mostly talked about the U.S. economy so far. Let's briefly shift gears and talk about economic conditions overseas. What are you seeing that might be of interest to our viewers?
So there have been a lot of interesting developments internationally over the past few months, and some are well known and others less so. We're all aware of the impact of China's ongoing zero COVID policies and the impact it's had on economic growth in China and the resulting supply chain issues that affected the U.S. and other countries. We all remain disheartened by the ongoing war in Ukraine and the impact it's had on European energy prices and then food prices more generally. Britain is going through a period of political turmoil with its prime minister having resigned last week. A headline that recently captured my attention discussed how Germany experienced its first month of a trade deficit in over 30 years. The story attributed this to higher prices for imported food and energy, as well as lower demand coming from China. I was also surprised to recently learn that the Japanese yen depreciated over 30% against the dollar over the last year and a half. Now, the main reason given is that the Bank of Japan has continued with its loose monetary policy, whereas you had stated earlier, Joe, our Federal Reserve is aggressively increasing interest rates to fight inflation. And I should note that inflation in Japan does remain considerably lower than that in the U.S. at about 2.5%. So bottom line, while there may be many different reasons, the economies of most countries are struggling.
So David, it seems like you've painted a pretty gloomy picture with high inflation, below trend employment growth, the cost of housing beyond reach for many Americans, and far from robust economic conditions overseas. What implications does this have for the stock markets, and how do you think stocks will perform from here?
Well, Joe, as you know, we don't try and predict the direction of the stock market. Last week on my 4-hour flight back home, I reread one of the great papers I've saved over the years written by a division of German insurance giant Allianz, and it was back in 2005 they wrote it. The title of this paper was The 7 Sins of Fund Management, and it's patterned after the 7 deadly sins that we've all heard about. The first sin is forecasting, led with the headline, "The Folly of Forecasting, Ignore All Economists, Strategists, and Analysts." The paper quotes Lao Tzu, a 6th century BC Chinese philosopher, who observed, and I quote, "Those who have knowledge don't predict, and those who predict don't have knowledge. Hence, I have no problem saying that I don't know how the markets will perform in the near term." But what gives me some comfort is some evidence that markets may have reached bottom. The first is the common valuation metric of the price-earnings ratio. This chart on the left looks at the current aggregate price of the top 50 mega-cap stocks compared to analysts' expected earnings over the next 12 months. And while PE ratios have come down, they remain above their 20-plus year average. And as you heard in our fund review from Evan, Wespath underweights the mega-cap stocks, so I'm comfortable that we remain underweight those stocks. The chart on the right shows the PE ratio for the small cap companies, and it appears meaningfully below its 20-year average. Sure, it has been lower, and I'm not predicting that it can't go lower compared to where it is today, but I do think that history has also shown that stocks often rebound soon after lows, so I have no reason to believe we won't eventually see a rebound. This next slide looks at PE valuations for developed international stocks on the left and emerging country stocks on the right. Here too, both indexes are trading below their averages. Now, I suppose I need to emphasize that these two charts are both based on analyst earnings forecasts, and you know what I said about forecasting. Hence, investors will be paying close attention to the upcoming earnings reporting season to assess the extent to which earnings expectations will come down and whether the attractive valuations I just presented will disappear. Now, the second piece of evidence is like a recent blog posted by our colleague Frank Holstein, where he explored the idea that negative consumer sentiment can be a positive market indicator. This next chart looks at individual investor psychology. Now, I realize, Joe, that this looks a bit complicated, and especially showing it near the end of our webinar. Each week, the American Association of Individual Investors conducts a survey of investor sentiment. Each one of the dots on the slide represents the difference between the percentage of investors who are bullish, that is, they have a positive view of the stock market, and the percentage of investors who are bearish or have a negative view of the market. I selected what appeared to me to be the 5 biggest outliers representing the 5 weeks over the last 20 years when investors were most negative on stocks. I then looked at when did the stock market reach bottom and how stocks performed over the subsequent year. So for example, if we look at the far left of the chart on October 16, 1992, the number of investors with a negative view of the market exceeded those with a positive view by 36 percentage points. Unsurprisingly, that week defined the market bottom, and stocks advanced 17% over the next year. And you can see how the other market performed for the other periods. We did reach maximum bearishness at the end of April, and we can't say for certain if the market has reached bottom since then, so we don't know if this time is different. But if history is a reasonable guide, then one might optimistically expect better days ahead. So I think that concludes my economic update, Joe. Thank you.
Thanks for your thoughts, Dave. It's a great discussion on a complex and changing investment landscape.